Hello everyone, welcome to Demand Supply Trading Practical session number 43 for the year 2025. Myself, Srujit Kakkar, and today is Sunday 9th of November 2025. And before we move ahead with the session, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. Now, we do have a channel on Telegram where we keep updating you with content related to demand supply trading methodology. So in case you've still not joined the channel, there are a few different ways you can join it. The first one is you can scan the QR code which is on your screen, and the direct link is also available in the description. You can also use that direct link to join this channel. Next, when you visit our website, which is srujitkakkar.com, just give me a second, I'll quickly show you. Once you visit our website, which is srujitkakkar.com, or you can use the short URL, which is sk.coach. You can just scroll down on any of the pages, and in the footer section of every page, you'll be able to find this banner which says join Telegram channel, and right in front of it, you have the join now button. You can also click on this button and join the channel. So like I said, this channel, we keep updating you with content related to demand supply trading methodology, plus when these live sessions are scheduled, we also update you regarding these live sessions there, so that you know well in advance when these sessions are happening, and you can take out time and join these sessions live. All right, now talking about today's session. Today's session is practical application of demand supply trading methodology. Now what we have done is our demand supply course is now available as a 100% free course. So if you have still not learned the demand supply methodology, you can learn it absolutely free. And how can you access the course? We'll talk about it as we move forward in the session. But once you go through the course content, you basically learn the methodology theoretically, right? What is demand supply, how to identify zones, how to qualify zones, how to plan trades. But unless and until we look into some practical examples, at times we don't get a very good understanding of how to implement the methodology. And that is what we do in these practical sessions. So every weekend, I do a practical session where we take some real life examples, and to those examples we apply the complete methodology so that you can learn how to plan trades in a very mechanical and systematic way. Now the best part about these sessions, and in fact there are two things about these sessions. The first one is that whatever analysis I'm doing, you're not looking into something which has already happened and justifying it, because like I always say, a move which has already happened, it's very easy to justify it. It's a piece of cake. You can apply a number of indicators, a number of oscillators, maybe even using price action, you can justify that move. But the real challenge is when you have to do the analysis in advance, and that is what we do in these sessions. We pre-plan the areas where we would like to be buyers and sellers, which means that when we are planning the trade, the move has not yet happened, and eventually when the prices will come back into those zones, that is the time we will see how the prices they react to those areas of demand and supply. And just because I'm sharing these examples in advance does not mean that I share these analysis with you and then we forget about it. Whatever analysis I share with you, whenever these trades they get triggered in the future, we also review them, and that helps you see both the before as well as the after. And because you can see the both before as well as the after, that helps you build a confidence in the methodology. So that's the first advantage of these live sessions. The second one is that at the end of the session, I also take your questions, queries. So if you have any questions, queries related to trading or to demand supply trading methodology, you can always put it in the chat box, and at the end of the session I try to answer all the questions that I get during the session. All right, so before we move ahead, let me also talk about some prerequisites, and if you complete these steps, this will make these sessions much more easier for you. So the very first one is our Trading Essentials course. So how do you access the Trading Essentials course? Just give me a second. Let me bring that up. So once you're on our website, you can see under Services, you have this Courses tab. Click on Courses. And the very first one is the Trading Essentials. You can click on it. Now what you can see is that this course is available in two languages, English and Hindi. So once you click on this button based on your language preference, it will straight away take you to our course content, which is all the lessons laid out for you in a very systematic way. And going through all these sessions will just give me a second. Right, so going through all these lessons will basically cover the Trading Essentials course. And once you're done with your Trading Essentials course, we will move on to the next one, which is the Demand Supply Trading course. Now, how do you access the Demand Supply Trading course? Same steps. Under Services, you have Courses. Click on it. And you can see the next one is Demand Supply. Click on Get Started. And here also you can see the courses available in two languages, English and Hindi. So whatever language you're comfortable with. Now mind it, there is no sign up required, no registration required. As soon as you click on these buttons, you get immediate access to the course content. Now, what will happen is when you go through these lessons, like I said, you will theoretically learn what is demand supply. But with theory, you also need to have the practical understanding of how to implement the methodology. And that is what we do in these practical sessions. Plus, these practical sessions are also recorded. So if you want to go through these sessions multiple number of times, you can also do that. Now, how do you access the recordings of the previous session? You can see at the bottom, you have this third button which says practical sessions. Click on it. And these sessions are also available in two languages, English and Hindi. So whatever language you're comfortable with, you can click on that button and you will have access to the recordings of the previous session. Now, the current archive is almost getting closer to 2 years of recording. So you have a lot of content available to you. And the more number of sessions you will watch, the better you'll start having the understanding of how to implement the methodology. All right, so that's your first two prerequisites. The next is during the live session, you will see that I use two documents, which is the rule book and the flow chart. And these two documents, they help us plan trades very mechanically and rule based. Now, how do you download these documents? Again, very simple. Once you're on our website under services, you can go to the download section. And in the download section, you can see you have the rule book and the flow chart. So you can simply click on the download button and you will have, give me a second. Perfect. So just a minute, let me set it up the way I prefer to set them up. Right, so just give me a second. Done. All right, so you can see that this is the flow chart. So the flow chart basically tells us what we need to do as a demand and supply trader step by step. Now all these steps, they have their own elaborate rules and those rules are available in the rule book. Now how do we use these documents? You will experience that during the live session. You will see I will be using these documents and planning trades very mechanically and rule based. Now before we start with our analysis for today, we do have few trades from the previous session which are getting carried forward, and I think one trade which got triggered during the week. So let's review these trades, and after reviewing these trades, we'll start with our analysis for today. So just give me a second. Let me bring up the very first one. All right, so just a second. So this is the very first one. This is from session number 37. We did the analysis on the 28th of September. And the prices came into the zone on the 8th of October. And since 8th of October, it has been getting carried forward for us. And you can see that during the week, we moved above our 1:1 mark. So it was an open trade for us for the last few sessions. But now this open trade can be can be converted into a break-even trade. So let's see, do we also have the opportunity to trail onto it? So for that, I'll click on all demand supply structures. So we can see we don't have any formation of new demand areas. So we can't trail onto it as of now, but you can definitely convert it into a break-even trade. So at this point of time, what we do is, if you talk about our rule is step 1. At 1:1, we make this trade as a break-even trade. Now, what do we mean by 1:1? So this is the risk which we took on that trade. And this is exactly the same distance, right? The same amount of risk we take and the same amount the price has gone in our favor. So when the prices move exactly the same amount in our favor compared to the risk we took on that trade, we call it as our 1:1. And at 1:1, what we'll do is, so this was your entry, this was your stop loss, that's your 1:1. So at 1:1, we revise our stop loss from a losing trade to a break-even trade. So this is where your stop loss will be revised now. So now the worst case scenario will be if the prices they go further down, this is no profit, no loss. And if it continues in our favor, we can keep trailing onto it unless and until it hits our target. So that covers the first one, which was getting carried forward for a pretty long time, I guess. It's been over a month. It has been getting carried forward. And anyhow, you understand it's a monthly income trade. So monthly income trades can take a month or maybe even few months for the trade to play out. So we understand that from the very beginning that monthly income trades can last for a few months. All right, so now that we are done with the very first example, let's look at the next one. This is from session number 39. So we also reviewed it the last session. So in the last session, we talked about that, yes, we came into the zone. In fact, let me do this. So this is where we came into the zone, and after entering the zone, we got a move which was 1:1. At 1:1, we talked about we can make it as a break-even trade. Then we had a formation of a new zone, and we talked about that from break-even. Now we can revise our stop loss, which is right here to the distal line of this demand area. So now the worst case scenario will be if the prices they come down, we will still be getting a small little profit. And if it continues to our target, we can keep trailing on to our target. And what happened eventually, you can see eventually prices they started moving down, and we would have been out of the trade as a small little profit, though we definitely got a move which was about 1:1, 2:1, 3:1. So after a 3:1 move, it started moving against us. But at least going with the rules, we got the opportunity to capture small little gains on it. Now that's your session number 39. We did the analysis on the 12th of October, and we got the entry on the 24th of October. So if you look at this, we probably would have got about maybe 0.7 or maybe 0.8 on this one, right? So we'll close this now as maybe 0.8, right? So that is what it shows as your reward to risk ratio. So that takes care of the second one, which was getting carried forward for us. And now let's look at the last one. Just give me a second. Just a few more seconds. I'm trying to load the next one. This is from session number 42. Right, so session number 42 is the previous session. Just give me a minute. So last session, we did the analysis for this one. And when we did the analysis, this was a type 2, type 3 trade for us. We didn't even get a 4:1 move where maybe we could have made the scoring a little better. So now the challenge is, you can see that one, it was a type 2, type 3 trade for us. Two, when the prices they started coming back into the zone, we also had this fresh area of supply right in front of us. So the reward to risk ratio was a challenge. So the very first reason, which is reward to risk ratio, we should have avoided this trade. Now I'm not sure whether we were at the best location or we were not at the best location, because if we were at the best location, we could have also verified our reward to risk ratio on the intermediate time frame. So this trade, I'll say, just because of the reward to risk ratio, would have been an invalid trade for us. But you can see prices definitely came into the zone. Whatever the target it was showing us at the time of entry, we would have got that target on the same day itself, which was about maybe 0.4. But the fact is that we don't take trades for such small reward to risk ratios. We should only be taking trades when our reward to risk ratio is at least a 2:1. Anything less than 2:1, we should be avoiding such trades. So we will be closing this. Just give me a second. Let me note it down. So this will be no trade due to your reward to risk ratio. Right? So I also keep a log of these trades. So that is why I need to note them down. So yes, this will be closed as no trade because of reward to risk ratio, and that basically takes care of the trades which got triggered in the past, and also the ones which got triggered during the week. Now we only have one which is getting carried forward. That is session number 37. We'll track it for the next few sessions and see how that one plays out. All right, so now that we are done with the review of these trades, let's get started with our analysis for today. So just give me a minute. Let me bring up the chart. So it's just going to take me a few more seconds. All right, done. Perfect. So whenever it comes to trading, I always say trading has to be a very mechanical and rule-based process. Now, why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. In case you have still not watched that video, do ensure you watch it. Understand the process I've explained. You might have to go through that process multiple number of times, maybe twice, maybe thrice. But once you have gone through that process few number of times, by default, you will start experiencing that you will start becoming less of an emotion-based trader and more of a rule-based trader. And that is why it is a very important step in the journey of your trading. So in case you have still not started with that journey, watch that video, understand that process, start following that process. There is no bypassing it. Now, since we need to be mechanical and rule-based, what we need to do is we need to create something which is called as a trade plan. Because if we have a trade plan, then we know what we need to do very mechanically and step by step. But the challenge is when you start learning trading or when you start learning a new methodology, it is not very easy to create a trade plan from day one. And the reason for that is that whenever we learn something new, uh, converting it into a mechanical step-by-step process is not possible unless and until we have a very good understanding of that process. And that is why creating a trade plan from day one becomes a challenge. And to overcome this challenge, what I've done is I have shared a ready-made trade plan with you, which is a combination of two documents. The first one is this trade plan steps. You can also call it as the walkthrough or the flow chart. And the second one is the rule book. So whatever steps I've given you, almost every step has its own elaborate rules, and those rules are available in the rule book. Now, mind it, the rule book that I've shared with you is a very conservative approach, because whenever we are learning something new, it makes sense to start on the conservative side. But once you start having a lot of experience, you can definitely modify that rule book based on your preferences. You can make it more conservative if you wish to. You can make it aggressive. You can make it super aggressive. It's your choice, because every trader has a different personality style. So you can always tweak it based on your personality style. So what is my step number one whenever we start planning a trade? So just give me a second, please. All right. So whenever we start planning our trade, step one is we need to define our trade purpose. So now the question is, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target. The exit can be break even. The exit can be the trailing stop loss. The exit can also be the stop loss, any kind of exit. So minded by exit, we just don't mean profit exit. Exit can be in profit, it can be in loss, it can be break even, any kind of exit. So now the question is, why do we start with the trade purpose as our very first step? And the reason we are doing this is because when we start doing our analysis, we use charts which are time-based charts, and we have n number of time frames available to us. So the very first challenge we face is that there are so many time frames available. So out of these n number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We again go with a very logical approach. And that logical approach is that the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration of the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, and monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets which are not 24-hour markets, so if you take the example of the NSE India market, I'm pretty sure you people, those of you who have been trading the NSE market, you would have experienced that every day when the market opens, some symbols they gap up and some symbols they gap down. Now, what can happen because of this gap up or gap down is that if you get a gap in your favor, you might get profit, which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, by holding that position overnight, we are taking that unnecessary overnight gap risk, which cannot be avoided. So this is why my recommendation to all of you is that initially your hourlies and dailies should be done as strictly intraday trades. We don't want to keep them as overnight trades and take that unnecessary overnight gap risk. Now, when it comes to weekly monthlies, we have no choice, but we will have to keep these positions as overnight positions. The reason is we are not expecting to get the exit the same day, right? So these are trades which can last for a few weeks or maybe even few months. So this is where we have no choice, but we'll have to keep these positions as overnight positions. But that does not mean that for weekly monthlies, we cannot have a gap against us. It can still happen. But since you're leaning against some bigger time frames, the probability definitely reduces. So again, initially your hourly, daily, strictly intraday trades, weekly, monthlies, overnight. But with time, with experience, if you want to include daily incomes into overnight trades, that can be done, but don't do it early on. Only when you start having that confidence in your analysis that yes, I can see that most of the trades, they move in my favor. Probably that is the time if you want to do daily incomes as overnight trades, that can be done. So again, your step one is you need to define your trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I've selected my purpose of trade, what is going to happen from the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 in the rule book, we start with the topic, which is multiple time frame analysis. because demand supply is not based on single time frame. Demand supply is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for entries and exits. And the refining time frame can be used for multiple purposes, like fine-tuning the zone, different kind of entries, like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now mind that this table, which is on page number 31, is specifically for the NSE market, because this market is only open for 6 hours and 15 minutes. If you're trading markets which are open for longer durations, then you can refer to the table which is on page number 32. Like if you're trading commodities, forex, you're trading cryptocurrencies, or if you're trading some international markets which are open for longer durations, then you can look into this table. But since I'll be taking the examples from the NSE market, I'll be referring to this table. Now, I have already opted that I want to plan monthly income trades. So from here, I got to know that as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly is the high time frame, which is used for curve analysis. Weekly is the intermediate, used for trend analysis. Lower time frame is daily. That is where we get our SETS from. SETS stands for stop loss, entry, target, and size. And in case you need to use the refining time frame, then your refining time frame will be the 60 minutes chart. So as soon as you're done with your step number 1, now you have the clarity to what time frames you'll be using, plus what is going to be the purpose of each and every time frame. You have clarity to it. So your challenge number 1 is taken care. Now the next challenge is, yes, I do know my time frames, but if you talk about NSE as an example, on NSE we have over 2000 companies listed. So humanly not possible that every day I sit and analyze these 2000 companies. So what we need to do now is we need to have a process in place which can help me get a smaller list out of this big list. And the more this list is in sync with my trade plan, the higher is the probability that I might be able to find something which is a qualified trade setup for me. So how do you get this list? For this, we use certain computer programs which are called as scanners or screeners. So if you'll do a Google search, you'll be able to find a number of scanner screeners which are based on conventional technical analysis or fundamental analysis. But the challenge was that there was no scanner screener available based on demand supply trading methodology. So that is where we also created 2 custom built tools. One is called as the demand supply zone alerts. The other one is the demand supply zone screener. Now, if you want to understand about these 2 tools in depth, you can definitely click on this. It will take you to the product page where the walkthrough videos are available. I'll also quickly show you how you can reach them via our website. So once you're on our website, you can just give me a minute. Just a second. Right, so once you're on our website, under services, you can go to trading view indicators. And here you can see you have alerts and screener. You can click on subscribe now. It will take you to the product page, and that is where the walkthrough videos are available. But what I'll do is I'll quickly help you understand how these tools they work. So I'll just give you a brief introduction about it. But yes, for more in-depth understanding, you can always watch the walkthrough videos. So starting with the alerts. So what alerts basically do is that here you can see that I have, see, as of now only the crypto market is live, so I'm showing you examples from the crypto market. So what you can see here is that in the alerts I have given a list of about 20 symbols, and currently I've applied it to a 5 minutes chart. Now those of you who have a free trading view account, what will happen is on your chart itself you can see that it will start shortlisting symbols for you, where during the live market you have formation of demand areas or supply areas. So like here you can see the first one is ETH USDT, and we have a rally based rally on it. So if I go to this and open ETH USDT, and let's go to crypto. So can you see we had a alert for rally based rally, and that's your rally based rally. You can see as soon as the zone was formed, it got shortlisted for us. Similarly, if I take another example, XPR USDT, sorry, XRP USDT. So here also we have a rally-based rally. You can see we have a rally-based rally. It just got tested on this particular candle. So that is what alerts they do, that during the live market, as and when you have formation of a demand area or a supply area, the table will keep getting updated. Now again, some of those of you who have a free trading view account, this is how it will work for you. Now those of you who have a paid trading view account, what can happen is, yes, you can always see the updated list on your chart. Plus along with that, you can also place alerts. So during the session, if some alerts they get generated, here you can see, can you see, this is how we keep getting these alerts. So you can also place your alerts on TradingView. So as and when during the live market, you'll have formation of these demand and supply areas based on whatever time frames you have selected, you will keep getting these notifications. So yes, it will work for anyone, irrespective whether you have a free account or whether you have a paid account. So on a free account, you will have the updates on your chart. On a paid account, you will get it as an alert along with this table on your chart. So can you see the 5 minutes got completed and now the list is getting refreshed. So you can see now it is giving me a different list of symbols. So this is how it works, that as and when you have formation of demand area, supply areas, it will keep updating you. So that's your alerts. Now talking about screener, let's understand how screener basically works. Right? So in the screener also, you can provide your list of symbols. Like here you can see, I have given my list of symbols, and then you have to define your proximity setting. So here you can see I've given my proximity as 2%. So can you see, as of now, we have just one symbol on which we have a formation of a zone, and that is how you get your alerts. And you can also see the alerts in your log. So the alert is for XPRUSD, that you have a formation of a drop-based rally on it. So anyways, coming back to the screener. So what screener does is you give your list of symbols. Like here you can see I've given my list of symbols, and then you provide your proximity setting. Like here I've given it as 2%. So for the alerts, the market needs to be live, right? Because only during the live market, as and when the zones are getting formed, you get notified for it. But for the screener, the market does not need to be live, wherever matches with the condition. So condition I've given is 2%, which means if the current candle is within 2% to a demand area or a supply area, it will get shortlisted for me. So just as an example, if I go to TCS, you will see that the current candle will be within 2%. To a demand zone. You can see we have a demand zone here, right? So it is shortlisting based on that. If I go to Bajaj Finance, BAJFI. So here also you can see we have a demand area, and since we are close to that demand, it got shortlisted for us. So this is how alerts the screener basically works, that the market does not need to be live. As long as the current candle is within that proximity setting to a demand area or a supply area, it will get shortlisted for you. And it is as simple as, even changing your time frame is as simple as just clicking on it. So currently it is giving me the results based on daily. If I change it to weekly, now you will see I'll have my I have my results based on weekly. So you can see in the weekly, nothing is matching with this condition. So just as an example, quickly, if I shift it up from 2% to 5%, let's see, do we get any results now? So you can see with 5%, it is telling me that Axis Bank is within 5% to a supply zone. So if I go to Axis Bank on the weekly, you can see we have a supply zone and we are within 5% to it. So this is how demand supply screener basically works. It helps you identify symbols where the current candle is getting closer to a demand or a supply area, or you can even modify it to identifying the symbols where you're already in a demand area or a supply area. So if you just think about it, if I was doing my analysis manually, I would have had to go through all these 15 symbols one by one to identify where I am getting closer to a demand or a supply area. But by using the screener, now I know I can skip the rest of the 12 and I can only look at these 3, because that is where I'm getting closer to the zone, and that is where my tradable opportunities might be. And then you can imagine, how much time it can save you, right? Analyzing 15 versus only going through 3 symbols. A lot of time saving. So that's the idea behind these screener. One, both the screener as well as the alert one, it helps you save a lot of time, because now you don't have to go through the complete list. You only have to go through the ones where the zones are getting formed or you're getting closer to the demand and supply areas. And plus now you can also monitor more number of symbols by giving that list of symbols in the list. So that's your alerts and screener. So now you have a brief understanding of how they work. But again, if you want to have in-depth understanding of how they work, you can definitely watch the walkthrough videos. All right, so let's get back. Just a second. Perfect. So again, step 2 is to get a smaller list. Now, how you get that smaller list, that's completely your choice. You can use the conventional technical analysis or fundamental analysis. You can use these scanners or screeners. Process can be as simple as, I just want to analyze the Nifty 50 stock. So now my list is restricted only to 50 symbols. Or maybe I have my own favorite list of symbols. But always remember, irrespective how you are shortlisting these symbols, whatever is getting shortlisted for you, you can never blindly buy or sell these symbols. So the scanner screeners, they do not tell you what you need to buy or sell. They only help you get a smaller list. Once you have that small list, you will have to analyze them one by one. And whatever matches with your trade plan can be an opportunity for you. Whatever doesn't match with your trade plan, you simply skip it. So that is how you get your list. So let's assume we got a list, and in that list, the very first one was ABC. So what are we supposed to do next? And next is we need to go to the lower time frame on ABC and we need to identify a zone. So I do understand that when you start learning demand supply trading methodology, identifying zone itself is a very big challenge. So what I've also done is I've also created an indicator on TradingView, which is called as the demand supply zone indicator. And what this indicator basically does is that instead of you identifying the zone, it automatically identifies the zones for us and plots it on the chart. So if you want to experience this indicator absolutely free, we do have a 7 days trial of it. So if you have still not taken the trial, how can you take the trial? I'll quickly talk about that as well. So once you're on our website, under services, go to TradingView indicators, and you can see the very first one is the zone indicator. Now the fact is, if you visit our website for the very first time, on the top itself, you'll get the notification that you have a option for a 7 days trial. But in case you have closed it, then this is how you do it. You reach the demand supply zone indicator page, and here you will be able to find the 7-day trial button. Click on it, and I'm pretty sure the direct link will also be in the description. You can also use that direct link. And what you need to do is, here you have to just provide your full name, your email address, and your TradingView username. Now, in case you don't have a TradingView account, you can click here and you can create a new TradingView account. And minded, this indicator also works on a free TradingView account. So it's not that you need to have a paid TradingView account. You can use it on a free TradingView account. And when it comes to NSE, you get live data for NSE on TradingView, even on a free account. So click here, create a new TradingView account if you don't have if you already don't have an account on TradingView. And once you have created your account, just provide your TradingView username here. In case you already have a TradingView account, you can click here, visit your profile, and that is where you'll be able to identify your correct TradingView username, because it is very, very important that when you're providing your TradingView username, it has to be correct, because if you're providing an incorrect TradingView username, it will not get activated for you. It will get activated to whoever that username belongs to. So make sure you provide the correct username. You'll get to know when your trial will expire. Then you just select the relevant option here. How did you hear about us? Click on I'm not a robot and click on finish and start your free trial. And once you fill this form within 24 hours, that is the worst case scenario. So within 24 hours, the indicator will get activated for you. And once it gets activated, you will receive a notification on TradingView itself that now you have access to the indicator, and then you can try it for free for 7 days. All right, so since everyone has that opportunity, you can try the indicator for 7 days for free. Whatever analysis we will be doing it based on the indicator, so that you can see the advantage of the indicator, how easy it makes the process for us to do the demand supply analysis. So let's assume this was the symbol which got shortlisted for us by the indicator. By the screener or whatever method you applied for getting your list of symbols. And you can see as soon as I applied the indicator is telling me here we have a drop based rally structure. It already identified the structure for us, and that's how easy it becomes identifying zones for us. And it can be used on any time frame. Just as an example, can you see if I move to a 5 minutes time frame, all my 5 minutes demand supply zones are already marked. If I go to 15 minutes, can you see? It takes less than a second and you have all your zones right there on your chart. So let's go back to daily. So this is where we have our drop-based rally. So step 3 was to identify the zone, and the indicator has already identified the zone for us. So my step number 3 is complete now. So yes, step 3 was identify zone. Do we have a zone available? The answer is yes. Now, once you have a zone on the chart, does not mean you can blindly trade it. The next step is to qualify it, which is a 2-step process. In step 1, will qualify based on certain conditions, and in step 2 will qualify based on the booster scoring. So let's do that. The very first one is level on top of level. So we'll verify that is this zone a case of level on top of level. Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different area. And how do we verify that? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, the concept is when your intermediate time frame zone divides into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, the very first requirement is that my lower time frame zone has to be inside the intermediate, which basically implies it has to be a coinciding level. So if we have a coinciding level, there is a possibility that it might be a case of level on top of level. But if it is not a coinciding level, it can never be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? In this case, our intermediate time frame is weekly. Now, a very beautiful example to understand what do we mean by coinciding level. Now, you might say, though it is partially outside, but even if this would have been completely inside this weekly, we will not call it as a coinciding level. Why? Because what does coinciding means? I said when you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones. So your intermediate time frame zone is here and your lower time frame zone is here. So lower time frame is not part of that intermediate, right? This is the test of that intermediate. We came into that intermediate zone, we started moving up, because of which that new zone was formed. So always remember that the basing has to be common of the intermediate and the lower time frame. Here the intermediate has a different basing, the lower time frame has a different basing. These are not common areas of demand, right? So that is why this is not a coinciding level. And since it is not coinciding, it cannot be a case of level on top of level. So the very first condition, level on top of level, is not applicable. Next one is gap. This zone is not because of a gap, therefore gap rules will also not apply. So level on top of level not applicable, gap not applicable. Pivot non-authenticity definitely applicable, because to drop based rallies and rally based drops, we always apply the rules of pivot and non-authenticity. So how do we verify pivot and non-authentic zones? If you talk about the aggressive rule, the aggressive rule says that the move from the zone should have violated one opposing zone. So if this is demand, opposing zone is supply. So the move from here should have violated one opposing zone, which means one supply, not on the same time frame, on the intermediate time frame, right? That's your aggressive approach. So let's verify that when we started moving up from here, did we violate an opposing zone? The answer is yes. You can see we have this drop base drop, and when the zone was formed and we started moving up, this supply zone was violated. Now how does it add that positive factor? If you think about it, a smaller time frame zone was able to violate a bigger time frame zone, right? It is almost like a kid was able to defeat an adult. So if a kid was able to defeat an adult, probably that kid has extraordinary strength, right? So that is how we are adding that positive factor. So yes, if I was a trader who is planning trades purely based on the aggressive rule, then this is definitely a qualified setup for us, right? So based on the aggressive approach, this is qualified. We can move on to the next step. Unstable equilibrium not applicable. So the only applicable rule here was the rule of pivot and non-authenticity, and based on that rule, when using the aggressive approach, this definitely got qualified for us. So after applying the applicable rules, is the zone qualified? The answer is yes. So now that we have a qualified zone, does not mean we can still blindly trade it. The next step is to understand its quality and the probability factor, for which we will apply the boosters. So let's go back. Let's start applying the boosters. Before that, what I'll do is I'll draw my entry stop losses, 1:1, 2:1, and everything. All right, so starting with the boosters, the very first one is freshness. The zone is definitely fresh. You can see that after leaving the zone, price has never been back to the zone, gets a score of 3. Talking about strength, we have an explosive move. That is the reason the indicator is identifying for us, gets a score of 2. Time at the zone, we only have one candle in the basing, which is again a score of 2. Reward to risk ratio we are taking as an assumption, because nobody knows how the arrival will be, and based on the arrival, the reward to risk ratio can change. Now talking about the location, if I go to the monthly chart, you can see that we have our monthly demand area, we have our monthly supply area, and my zone is located inside of my monthly demand zone. So we are basically planning the trade at the best location, and best location gets a score of 2. Now, when you are at the best location, trend becomes irrelevant. It doesn't matter whether you are in an uptrend, downtrend, or sideways. All of them can be traded with a score of 1. But if you want to still re-verify, you can see that when you go to the intermediate time frame, you can use the zone violation analysis on the indicator, and the zone violation analysis is telling me we have violation of 2 supply areas, which probably means we are in an uptrend, right? So we are already in an uptrend. But like I said, that when you are at best location, trend becomes irrelevant. So even if you wanted to skip it, you could have skipped it, because by default this would have been a score of 1. Now, move from the zone, we need 4:1. We already have a move which is more than 4:1. Talking about level on top of level, we have already verified, not a case of level on top of level, not even a coinciding level. Now, can it work like a trap? Let's verify that. I'll take a horizontal line wherever the proximal is. I'll zoom out a little bit, and then I'll try pushing it up and try to identify an area where the prices have been bouncing over and over again, right above this area. So if I start pushing it up, probably somewhere around here, I can see it working like support here. Then I can see it working like resistance here. I can see it working like support here. And if I go back in history, you can see it has been working like resistance. It has been working like support. So it's almost like a textbook example of support resistance. Can you see? Beautiful area of support, beautiful area of support, then acted like resistance, then almost acted like support, then again here acting like support, right? Somewhere here it was acting like resistance. So what happens is, when you see these very clean area of support and resistance, other people who trade based on conventional technical analysis, they will also see it as an area of support and resistance. So what they'll do is, because this will be more of a support, at support they will be interested in buying, and their stop losses will be placed below this area, and those stop losses will be sell orders. And similarly, if we have a breakout, people who believe in breakout, they will also start selling. So we understand by the time we reach this area of demand, we'll have a lot of selling coming into the market because of the stop losses, because of these breakout traders. And these traders are now making 2 mistakes. Mistake number 1, they will be selling after a decline in price, which means they are now selling at a cheaper price. Mistake number 2, they are not just selling anywhere on the chart, they are also selling in an area where the chart has proven to us that back in history, demand exceeded supply. So definitely the possibility is there that this might work like a trap, for which we will give it a score of 1. So if you look at the overall scoring, we have a high quality zone with a score of 10 out of 10, definitely with the assumption of reward to risk ratio, and a high probability setup with a score of 6 out of 8. So high quality, high probability can be done as a type 1 trade. So after applying the boosters, we got to know that this can be done as a type 1 trade. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So now we need to be ready for the worst case scenario, for which we'll do our proper position size calculation, so that in case the trade does not go in my favor, it goes against me, I should not be losing more than what my trade plan allows me to lose based on the risk management rules. So we need to do our position size calculation. Now, whenever the prices are back, we'll have to re-verify, because the markets are not static, markets are dynamic. Conditions are changing almost every other second. So before entering a trade, you will always re-verify that does it still qualify based on my trade plan. If the answer is yes, we place our order based on the entry type, in this case the type 1 trade. And then the last step is your trade management, where step 1 is 1:1, we make it as a break even trade. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. And this is how we plan trades, very mechanically and rule based. Now, if these sessions are helping you plan better trades, then do like the video. And if you have any friends or family members who are into trading, or if you're part of some trading group, then I would highly appreciate if you can share the link to my course content. The course is 100% free. These live sessions are 100% free. The recordings of these sessions, you have a lot of content available to you. So the more number of people they get access to this content, which is available 100% free for everyone, the more advantage they can take of it. And I'm pretty sure that you people also understand that a lot of people are struggling with trading. So sharing it with the trading community might help somebody. So I'll highly appreciate if you can share the link to the course content, to the live sessions, to the recordings, or maybe even to the trial of the demand and supply zone indicator. Now, what I do is, at the end of the session, I take your questions, queries. But before I take the questions, queries, I would quickly add one more thing. A feedback that we have been getting from you people was that, yes, at the end of the session, you definitely take your questions, queries. But what if I don't want to ask my question publicly? Or what if I want to share my analysis, which is not possible with the YouTube live chat? So once you visit our website, you can see on the top right corner, you have this option which says one-to-one session. So with this one-to-one session, you can definitely book a one-to-one appointment with me. Now, there are two kind of appointments available. One is a voice call. The other one is an online meeting. So if you feel that on a voice call, you can ask your questions, you can get the answer to it, you can go for a voice call. And if you feel that you would like to share your screen, you would like to share your analysis, then you can go for the online meeting. Otherwise, you can always put your questions in the chat box at the end of the session. I'll definitely try to answer as many questions as I can. So let's see, what do we have in the chat box today? When qualifying zone based on authenticity and non-authentic, do level on top of level and coinciding zone bypass the fact that it has to remove an opposing zone? Okay, so what you're saying is that just to make it very simplified, if we have a coinciding level, or if we have a case of level on top of level, can we skip the rules of pivot and authenticity? The answer is yes. And the fact is, if you go through the rule book, you will see that I've already given that rule in the rule book. Can you see, for level on top of level, we have that additional rule that there is no need to apply the pivot and authentic rules, as level on top of level by default adds that extra probability in our favor. The same can be applied to coinciding if you wish to, and this is also applicable for the pro gap. Even in the case of pro gap, if you see those pivot and authentic zones, that can be skipped. Right. So again, this rule book has been designed based on some of the most common questions that I get. And you will see that if you go through the complete rule book, almost all your questions would have already been answered in that rule book. So that basically answers your question. Next is it possible to semi-automate the strategy where I do all the analysis when price is about to get in my zone, I verify all necessary, allow EA to do the rest? For this, an EA is not required. The very simple thing is, now let's take this example itself. So let's assume that the prices are coming back into the zone and I've verified everything that it is still qualifying based on my trade plan. Now all I need to do is place something which is called as a bracket order. So once you place a bracket order has your entry, bracket order has your stop loss, it also has your target. So what will happen is, now it will manage everything automatically. So after your entry, if the prices go to your target, your stop loss will be cancelled. If it goes to your stop loss, your target will be cancelled. But yes, manually you will definitely have to trail onto it, right? So once it goes to your 1:1, you will have to modify your stop loss order and bring it to your entry point. So those things, yes, you'll have to do it manually. But yes, to a large extent, by placing a bracket order, everything is taken care of. All right, so take buy trades on a demand exit if price hits a certain level. TP2, so I'm not sure what you mean by TP2. A number of trades to take, risk appetite, trailing, break even. My problem is I keep interfering with my live trades, too much emotions. See, I have said this many times in the past that if you talk about trading as 100%, 60% is definitely emotions, right? 30% is your risk management, and the balance 10% is your methodology. So yes, emotions play a very important role, and that is why I whenever I start the session, I always start with that particular video, which is how to start trading. And I keep emphasizing you have to go through that process, maybe twice, maybe thrice, maybe even 4 times, maybe even 5 times. So unless and until you start feeling that now you're more of a rule-based trader, keep going through that process over and over again. And that is the only way to shift from a person who's planning trades based on the emotions to planning trades based on rules. And see, the only way it happens is when you see the results. And that is why you have to go through that practical process, which I've explained in that video. So I do understand emotions is one of the biggest culprit, I'll say, when it comes to trading. Most of the times we definitely, at times what will happen is you'll have a very beautiful trade planned for you. You, let's say, have a demand zone, but prices are falling like crazy and you will be scared to press the buy button. And what you will realize the next few minutes, prices, they just give you a beautiful bounce. Maybe within few minutes you have a 4:1, 5:1. And then we keep thinking, why did I not take that trade? So again, only way is by doing the trades practically. And what is the right way to do it, I've explained in that video. So do ensure watch that video and follow that process. All right, let's see what we have next. In the log sheet, we have type 1, type 2, type 3. Can you make it in a way type 2, type 3 to be totally different, where type 2 will be trader to wait for the entry on refining time frame, and type 3 to see again, when it comes to type 2, type 3, what you need to understand is type 2, type 3 basically implies a trade where I'm not placing an order in advance, which means it is not a limit order. And why are we doing that? Because we understand that these trades, they are either lacking the quality or they are lacking the probability. So that is why I want to see some positive factors before I get into the trade. So technically, type 2, type 3 is just a trade which is a little lesser probability or a lesser quality. Now, how do I approach that? That is what we call it as type 2 or type 3, right? Type 2 would mean that, let's say in a demand zone, as soon as I see a bullish candle, I immediately buy. Type 3 would imply that once I see that bullish candle, price has to leave the zone and then I buy. So technically, they are just trades where we are trying to enter the trade in a conservative fashion. Now, how conservatively I want to add, just after the candle or when the price is leaving, that is completely your choice. But technically, they are exactly the same thing, right? They are basically a trade setup which is a little lesser probability. So you might not want to take type 3 trades, but let's still call it as type 2, type 3, and you're only interested in taking type 2 trades. It's still acceptable, but we cannot separate them as a type 2 or a type 3, because type 2, type 3 is only a one setup which can either be taken as a type 2 trade or a type 3 trade, right? It's not that type 1 setup is a different setup, type 2 setup is a different setup, and type 3 setup is a different setup. Type 2, type 3 is exactly the same setup. How you are approaching it, that is what we are calling as a type 2 entry or a type 3 entry, right? So that is the only difference there. All right, so how do scan stocks have coinciding demand supply zones on MIT via scanner? See, coinciding is by default not possible, but one thing you can do is a very simple example can be, now it is not 100% that it will always shortlist coinciding levels for you, but just as an example, something which can be tried could be something like this. What you can do is, let's say I go to the weekly. So first thing is, now I know, let's assume that I give it as 10% so that, you know, it is shortlisting something for me, right? So let's say 10. And what I'll do is, I'll just layout. It's also added here. So the first thing is, when I applied it to the weekly, I know ABB, Axis Bank, HCL Tech, and ITC are the ones where we are getting closer to the areas of demand and supply. So now what I can do is that in this screener, instead of having all the symbols, I can only give ABB, right? I can give HDF, sorry. The next one was Axis Bank, HCL Tech, and ITC. And now I can apply to the daily chart. So what is going to happen is, I've already identified the ones where I'm getting closer to the weekly areas. Then I am identifying where I'm getting closer to the demand area. So that might help, but there is no way where I can say, okay, only find coinciding levels for me. And yes, though it can be added as a feature, the challenge will be that if the indicator has to do multiple time frame analysis, we will have to further reduce the number of symbols it can look into. So here you can see we have about 15 symbols. So if I want to make it an indicator which is using 2 time frames, I'll have to push it down to maybe 7 symbols, right? So that is why we have not done that, used multiple time frames. We are only using single time frame, but probably this is the only way to do it. First identify based on the higher time frame, and then go to the lower, get that list of symbols, and then go to the lower time frame and see, which ones might be coinciding, right? That could be the only logical way to do it, but that does not guarantee that it will shortlist all coincidings. But yes, you might get a lot of coinciding levels when you're doing this process. All right, so what's an EA? So EA is more like, an algorithm, right? Which is automatically placing the orders for you, managing your trades, right? That is what it basically implies. All right. Can we say liquidity zone is same as demand supply zone? So, the thing is, I will have to first understand what do you mean by liquidity zone, right? But yes, demand supply, people can use different terminologies for it. So maybe if you're referring to the same kind of area, but just using a different terminology, that can be it. But I cannot say a yes or a no to it, because to say a yes or a no, first I need to understand what do you mean by a liquidity zone, which as of now, I have no clue what do you mean by a liquidity zone, right? So I'll just say that if it is exactly the same kind of analysis that we are doing, then yes, you can call liquidity zone exactly as demand and supply. But if it is something different, then definitely it is something different. All right, so that brings us to the end of today's session. Thank you everyone for joining in. I'll be seeing you the next weekend. Till then, trade safe, enjoy your Sunday. Take care. Bye bye.